Hello, this is Bill Moreland with Bank Reg Data. Today I'm going to answer the question, do performing loan modifications, or TDR as it was formerly known, troubled debt restructuring, do they predict bank failure? And they do, obviously, otherwise I wouldn't be talking about the subject matter. I I think this is a video I've been debating to do for a couple of weeks now. This analysis that I'm going to show is a couple of months old, but I've got to be careful not to keep beating the same subject, right? Because I fear losing interest. But at the same point in time, this is a not insignificant issue. So first off, a little bit of a background on this. Performing loan modifications is kind of a misnomer. When we say it's performing, what that means is it's not on non-accrual, and it's not delinquent, either 30 days past due or 90 days past due, 30 to 89, 90 plus. So it is a misnomer, and I'm going to keep using that, and because it gives the perception that a loan that has been modified is a good loan, and the risk profile is exactly what it would be on the rest of the portfolio, and that is far from the case. So a couple of things. One is I got personal experience doing TDR when I was at Wells. I'm a big fan of it, actually, in a proactive way. The issue with it is if you're doing it the right way, you absolutely have to put the modified loan. Couple rules. One, you don't modify a delinquent loan. That is a big no-no, or at least it was 27 years ago. The second thing is you have to put it on non-accrual. And by putting it on non-accrual means you're not recognizing interest and fee income. So the idea behind this is I can't make my payment, right? I got $1 million loan, my payment's $40,000 a month for a fixed term, and I can't make it. And so I work with the bank, or the bank works with me to drop that from 40,000 down to 25. And then I make my payment. Well, we shouldn't do cartwheels, because the reason that I'm able to make that $25,000 payment is because that's what I said I could make, right? So you're supposed to put that on non-accrual. But Wells, and I was very aggressive with this, as per our management team, who coincidentally, the group I was in was some of the smartest people I've ever worked with. They were very sharp people. So we were very aggressive because we were worried about Y2K and moving into a recession around that time frame. We were getting long in the tooth. What we found is it just doesn't work, right? It temporarily solves a problem, but in a deeper recession, or even a shallow recession back then, it just pushed that problem out 18, 24 months. So that's why you have it on non-accrual, so that you get 12 to 15 to 18 months of payments. You're totally getting principal pay down. So instead of charging off, 90 or 100% of the balance, you're charging off 75. So it does lower your charge-offs. I also have experience with the subject matter as an entrepreneur. And I'm going to talk a little bit about a bank called Lydian Private Bank. There's nothing magical about these guys. I could pick several others, but some of these banks are still in existence. Lydian's not. They basically went under in June 30th, 2011 was their last call report. And what you're looking at here is when they became a Bank Reg Data client. Right there at that time frame, September 30th, 2010 was the most recent time quarter. They were actually client number 30 because we rolled out the service in June 28th, 2010, because I got horrible timing. Couldn't have done it 2 years earlier, right? And they became a client within 3 months. Client number 30. And the reason they became a client, they weren't happy. But the reason they became a client is because one of their board of directors had stumbled across Bank Reg Data and saw that they had a very high 195, 204 Texas ratio. And that's high. That's very high. And I'm not a fan of Texas ratio, to be honest with you. I don't think it's a very good predictor of risk. It's too late. It's a rear view indicator. You're high and you're poor. And about 100, 150 is when a bank starts to get itself into an elevated trouble area, an elevated risk. So the problem with it is it doesn't tell you anything about where they're headed, right? And so if we go back to 2008, they were at 60 and 85, which is elevated, but there's nothing to say whether it's going to drop back down to 30 or it's going to go to 207. So another one of the many hats I've worn is predictive modeling. I've done a lot of predictive modeling in checks, credit, lending, small business lending, bigger lending, debit transactions, fraud, credit, you name it. I've probably built models or built groups around it. So I tend to think in terms of event outcome, right? And so Lydian was very elevated. And what the ratio does is it basically takes non-performing assets plus performing restructured loans plus REO, other real estate owned. And it divides it by a bank's ability to absorb losses, which is going to be your tangible equity and your loan loss reserves, which is going to be essentially that column right there. But what you'll notice during this time frame, and this is why Lydian was frustrated with us, but it doesn't us, it's the ratio, right? It's not my data. It's not my calculation. I'm just making life easier and quicker and simpler to get into and analyze. But you'll notice of their $308 million of troubled loans, 207 of them were performing TDRs, which were restructured loans to get the payment down so that the borrower could make it, and they didn't put it on non-accrual. But the whole point behind the Texas ratio is it captures the entire risk profile. And so what was happening is they were getting quite aggressive a year earlier and performing TDR. It jacked up their Texas ratio, right? From 101 to 214. So they were having problems in their base well before they started to do performing TDR. But then they really jumped into loan modifications to try to solve the problem. So this bank is about a $2 billion bank at the time. And they were pushing heavily to modify the Texas ratio to remove performing TDRs. So I get it, right? I get it when I was at Wells and we did it. And I did a lot of TDR there. The group I was in was very sharp, very aggressive, some of the smartest people I ever worked with. But the investor relations group hated it. And we got called on the carpet a couple of times, jokingly, but not so jokingly. You need to stop. You're doing too much TDR. And we're having to put it on non-accrual. And Wall Street doesn't like it because once it goes on non-accrual, it becomes a non-performing loan. Just like Lydian is now complaining because Bank Reg Data is showing this data. Wells Fargo was doing the same thing when I was there. So at an entrepreneur level, right, we're 3 months in. And now all of a sudden my phone's ringing off the hook. And it's not just Lydian. It's a number of people. You've got to take away performing TDR. I'm like, no, man. It's not my data, right? It's bank's data. 2, it is the ratio. As I mentioned earlier, it's the way it's calculated. This is not a Bill Moreland or Bank Reg Data specific. And did you lower the payment? Yeah. Would you have normally put it on non-accrual? Yeah. So why is it not considered a troubled loan, right? And so they signed up and we knew we were not likely to get a renewal. And the reason for that is when you have a lot of restructured loans, you're going to get that second wave of delinquencies a year later, and the bank's going to go under. And so it's not a surprise that you start to see a big restructuring, and then a couple of years later, their last call report was June 30th, 2011. So anecdotally, I have these things in my mind, right? And it's not just Lydian. So from an entrepreneur's perspective, I witnessed this behavior. And the banks that failed, I went and looked at them, right? You bring them up, you look, and you're like, same thing you're seeing again and again and again. Capital's eroding, NPLs, high loan growth, certain portfolios. And it's not just mortgages, it's not just commercial real estate. You start to see a degradation across a number. You're getting a series of cascading problems across multiple portfolios that's degrading the bank's position. And one of those that was very common was performing TDR. It was a marker of people who didn't survive. The problem is there's no big, massive database anywhere that says bank failures. Yeah, there may be a list of bank failures, but think back to the time frame and think back longer if you're from other cycles. Not everybody who fails, right? What can happen is the FDIC can encourage mergers pre-failure Friday. And there got to a point where we stopped doing Failure Friday because everybody started to expect it and then track it. And the market fundamentally would trade on how many banks closed on Friday night. Monday morning, you would start to see some trends. So it is not, understand, we don't want banks failing, but a bank can disappear and still have been a failure. So the trick to an analysis like this, event, outcome is how do we analyze and look at Lydian, but predict banks that are failing. And so what I did is I basically said, look, we're going to take 2009 Q1, and we're going to take all the banks in 2009 Q1, and then we're going to track them for 3 years and to see whether or not they still exist, right? Is that call report still being filed? Is that entity, and this is done at an institution level. So I'm adding up multi-cert holding companies into one entity because you can consolidate certificates, and that's a gone, but you're just consolidating a five certificate multi-cert entity into one. Is that 4 failures? No, not really. But if you do it by institution or holding company number, that bank still exists. So those are not failures, right? But you can have legitimate mergers in a happy way where the bank grows, gets an offer, and sells. And you can have mergers in an unhappy way. And then you can just have flat out failures. So what I'm trying to capture here is, and we're going to look at Lydian right there in the yellow, is in March 31, 2009, what was their max reported call report, and were they gone? And I just created an outcome, right? Were they gone in 3 years? And that gone could be failures, it could be mergers, happy situations, but it won't be consolidations, right? I've removed the consolidation issue from the multi-cert by looking at an institution level. Assets, what's their loans? What's their performing TDR? Now, remember, once again, this is the loans that have been modified to get the payment down. And now we call them loan mods, but at this time they were TDR, troubled debt restructuring. These are loans that should have been put on non-accrual, but they weren't because they wanted to avoid the stigma of being non-accrual, which then is a non-performing loan scarlet letter. So what you're looking at here is a performing TDR percentage of 496 basis points, almost 1/2%. So I then created a series of categories, right? Higher, lower, where are you at? So now we have the beginnings of a predictive model, a one variable model, which says, what were they at on 2009 Q1? Well before we were just starting to enter, very similar to today, right? We're just now entering these troubled times and we're getting deeper into it and we're starting to see the issues. But at 2009 Q1, this very much would have been a predictive measure, not a rear view indicator, but a predictive measure. So you're obviously already probably ahead of me on this. That's it. This is what the outcome is 3 years later. What percent of these banks are gone? And the 0 means they had no performing TDR as of 2009 Q1. There were 4,940 institutions and 392 of them no longer existed 3 years later. So this would probably be a good baseline, right? And that baseline is about 8%. About 8% of the banks were gone. And you're going to get normal consolidation. Plus, there was no de novos. There's still no de novos. I'm begging you, please, fewer choices are not better. We want more choices as consumers and a healthier economy. We don't want fewer, but understand 8% is probably what a normal, happy merger scenario is. Now, some of these banks could still have gotten in trouble, and some of them still could have failed. They just didn't exhibit behavior in 2009 Q1. Now what we're seeing is almost a direct relationship as it goes higher. So 1 to 2%, there were 371 banks for 17%, then 23%, and then 32%, and then 42%. So there is from a predictive modeling perspective, this is kind of the holy grail. This is what you're looking at when you're building predictive models, is you're looking for two things. One is a very clean linear relationship that goes along with what your expectations are. But two, it is not an insignificant number of predictions. So for example, if we say, what is greater than 2%, right? Greater than or equal to 2% of your loan portfolio has been modified, but not put on non-accrual. You're now starting to get into, remember, allowance levels are only like 1.5, 1. So if you're restructuring more than you have as reserves, that's problematic, right? There were 340 banks, and 94 of them basically were gone in 3 years for 28%. So what you're looking for is predictability, directionality, and you're looking decent volume. That's 94 out of 682. And I would venture that if we had a true failure, it's a much higher ratio, right? Because part of that 682 is happy mergers. Maybe not a ton during this time, but there's always mergers that are growth mergers or market mergers or, retirement mergers or getting out of the business. So this is very much a very strong indicator of failure. So the next question that should automatically be popping into our mind is, how many banks right now have that profile, right? Bill's barking about this. Bankreg data won't let that. They're like a dog with a bone. It is driving me crazy. But why is he bringing this up? Well, I'm bringing it up because we're at 2009 Q1, probably in the cycle, right? Maybe a little earlier, maybe a little later. There are 62 banks right now, as of Q1, that have more than 2% TDR performing levels. And if history repeats, which it may not repeat exactly, but it'll rhyme, and if we have a deeper recession, which I don't see this being shallow, this is going to be a longer, deeper time frame. This is going to be more reminiscent of deeper cycles. We should be looking at those 62 banks right now and asking some hard questions, right? Because the expectation is maybe 25 to 30% of those banks will be gone in 2 years. So the reason I went ahead, I tabled this analysis for a couple months. But the reason I'm showing it now is, what do you think Q2 is coming in at, right? And so a good example of this will be Amboy Bank, right? And so Amboy is one of the earlier bigger banks, 2.6 billion in assets right here. They've already filed their Q2. And so they're one of the earlier publicly traded banks. Most banks wait till the end. But there are 950, 975 banks that are filed. They're in the system that have UBPRs that all their sister banks have filed, so we can push them up. Amboy, from a performing TDR perspective, so we go to loans 2012, we go to modifications, and we come in and we look. Please do not look at this history. That history doesn't count anymore. There was a new definition and a wipe clean of the performing. It got wiped clean. And my understanding is becoming more nuanced in this, is it's FASB that's kind of driving this. Less the FDIC, more the national accounting standards. But remember my skepticism, right? I worked at Wells. I know the pressure. I got called into the risk committee and the investor relations committee in San Francisco twice. You got to stop. But this is the right thing to do. I don't care. I don't care that this is what you think is the right thing to do. Wall Street doesn't like it. And then we kept doing it, but not to the same level. The second time is, Bill, stop, or we'll find somebody to do this in place of you. And it wasn't that harsh, but it was. I mean, it wasn't like we're going to fire you, but it maybe you no longer be in this decision-making ability. So I get Wall Street's desire to not want to show the statistic. I also get the entrepreneur's understanding of this, that Lydian didn't like it. And they were not by any stretch the only bank. There were a lot of banks, CFOs and chief executive officers and presidents that called and said, we don't agree with this. I'm like, man, I don't want to irritate a potential prospect, but it isn't my numbers, man. It's not my data and it's not my ratio. So forget the history. They were fine. They had no performing TDR. And then all of a sudden we see 28 million bucks. And lo and behold, they're at 1.51%. So go back here. They've gone from the 7-8% range to double, right? Just that change. If we assume that this is a good predictive variable, they've just entered a much riskier profile in terms of survivability. And what we see is it's multifamily for $18 million. And you can see a prior TDR. And that's the beauty of TDR, right? And so I'm going to be, look, is it on performing? Oh, yeah, performing, right? So they had it but it was making pay down, right? That loan, probably one, maybe two, but it was probably one multifamily loan to their credit that they modified. I would have preferred they put it on non-accrual. They didn't, but it did pay down. Now, is it gone? No, don't make that assumption. It could very much be on the portfolio, but it got wiped clean, right? There was a 2023 reset on anybody who had made 12 payments. So when we see this $18 million, this is a brand new loan, one or two probably, but what you see is a pattern of behavior. They did the same exact thing on construction, other. So Amboy did not show up last quarter. If you would have said, how many banks? 62. 60, and you can pull it up on Bank Reg data. If you're a client, you can go in, you can export. There's an export that gets performing TDR. It's a ratio. The analysis, this entire analysis took like 15 minutes. It's not hard to do. And to get the list of banks is even quicker, right? It's one click, submit, and then play with it in Excel. So we now know that Amboy, and I'm not picking on them, but they're publicly traded. They're one of the first bigger banks to file that's available in Q2. We're seeing banks that weren't in Q1. So I'm expecting that if we track this, how many banks are greater than 2%, and we'll call it a Bill Moreland ratio of risk, and just keep annoying everybody. But I'm betting you we're upwards to 90, 85, 90 banks in Q2 will have greater than 2% set on performing. And so what this tells us from a predictive perspective, from a history perspective, from a understanding at a personal level what this means for the banks themselves is what the pressure is. It's getting worse. It's going to continue to get worse. And frankly, this variable, I would say, is as good as CRE concentration ratio is at predicting future trouble. So I'm not on a crusade. I'm not trying to convert everybody, but I should have been more vocal on talking about mark-to-market losses. It was obvious to us. It was obvious to a lot of our clients that Silicon Valley had problems 6-9 months before the market realized that they were not in a good position. So I'm not trying to be Pollyanna-ish on this or Chicken Little, but at the same point in time, I'm hard pressed to think that this is not going to get worse. And I would prefer to get ahead of this, or at least go along with the ride to try to educate our user base or our prospect base in terms of what is it that you need to look at if you're worried about your stock investments, your counterparty risk if you're treasurers, your clients if you're vendors or consultants, regulators, examiners. We have several. We have a lot of different client segments that should benefit from understanding the subject matter and using the tools in Bank Reg data to look for those banks that may be problematic. As always, I appreciate your time. If you have any questions or comments, please feel free to reach out. Thank you.